you're probably tipping the CRA thousands more than you need to. Not because you're doing anything wrong, but because you're filling your accounts in the wrong order. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Here's what most Canadians do. They contribute to their RRSP because someone told them to. Maybe put some money in the TFSA and hope it all works out at tax time. They use round numbers, $5,000, $10,000, because those feel right. But there's an actual sequence and specific amounts you should be using that can save you $5,000, $10,000, or even $30,000 in taxes over your working years. Today, I'm walking you through the exact 5-step framework I use with my financial planning clients. This isn't about tax evasion. That's illegal. This is about tax efficiency, which is your responsibility as a Canadian taxpayer. The CRA gives you these tools. Your job is to use them in the right order, with the right amounts. By the end of this video, you know exactly which account to fill first, how much to contribute down to the dollar, and why the sequence matters more than most people realize. Let's break it down. The first step is what I call marginal rate arbitrage, which starts with your RRSP. Now, most people think of the RRSP as just a retirement account, but what it really is a tool to lower your taxable income and put it in a lower tax bracket. That's the arbitrage. You're trading today's high tax rate for tomorrow's hopefully lower tax rate in retirement. Here's what matters. You don't just contribute to your RRSP. You contribute strategically to hit a specific tax bracket. Most people contribute round numbers, $5,000, $10,000, $15,000. CPAs contribute strategic numbers based on where the tax brackets actually break. Let's use Michelle. She's in Ontario and earns $96,000. At that income, she's paying 31.48% marginal tax rate. But in Ontario, there's a tax bracket threshold at $94,907. Drop below that and our rate falls to 29.65%. If Michelle contributes exactly $2,000 to our RRSP, our taxable income drops to $94,000, just below the threshold. That saves her approximately $630 in taxes this year. But here's the key. She's now in the lower tax bracket, which means every additional dollar she saves this year is taxed at 29.65% instead of 31.48%. If Michelle contributed a random $5,000, a nice round number, she'd get a bigger refund, about $1,483. But she wouldn't have maximized the strategy. The goal isn't the biggest refund. It's positioning yourself in the right bracket both now and in retirement. Your action step here. Look at your income. Check the federal and provincial tax brackets for 2026. Then contribute just enough to your RRSP to drop below a bracket threshold. Don't overcontribute and don't undercontribute. Target the threshold. Quick note, if you're earning under $55,000, your marginal tax rate might not yet justify heavy RRSP use. In that case, prioritize step 2, the TFSA, and come back to the RRSP when your income climbs. But here's a contrarian insight most people miss. Even if you're a high earner, RRSP first might not be your best move. If you have a defined benefit pension coming in retirement, you could end up in a higher tax bracket when you're 71 and forced to convert your RRSP to a RRF. In that case, loading up your TFSA now while maxing your RRSP later might make more sense. General guidelines. Under 60K with a pension, TFSA first, then RRSP. 60K to 100K without a pension, split contributions, RRSP to target bracket thresholds, then fill your TFSA. Over 100K, RRSP first to maximize the arbitrage, then TFSA. The key is thinking about what your retirement income will look like, CPP, OAS, pension, IRF withdrawals, and making sure you're not accidentally pushing yourself into a higher tax bracket later. Once you've maximized your RRSP contribution for tax bracket purposes, the next step is your TFSA, what I call the growth shield. Here's the thing about the TFSA. It's not just a savings account. It's a tax-free growth vehicle, which means everything that happens inside it, interest, dividends, capital gains, is completely sheltered from tax forever. Most people use their TFSA for emergency savings or short-term goals, and that's fine. But if you want to build serious wealth, your TFSA should be holding your highest growth investments. Think equity index funds, growth stocks, anything that's going to appreciate significantly over time. Why? Because when those investments grow inside a taxable account, you pay capital gains tax on 50% of the growth when you sell. But inside a TFSA, zero tax ever. Let's say you invest $7,000 in the Canadian Equity Index Fund inside your TFSA. Over 20 years, it grows to $28,000. In a taxable account, you'd owe tax on $10,500 in capital gains, 50% of the $21,000 gain. At the 31.5% marginal rate, that's $3,307 in tax. In a TFSA, you'd keep the entire $28,000. Your TFSA contribution limit for 2026 is $7,000, and it carries forward if you haven't maxed it out in previous years. So if you've never contributed, you could have $109,000 in total room. If you have TFSA contribution room left after your RRSP, prioritize high growth equity investments inside the TFSA. Save your low growth stable assets like GICs or bonds for your taxable accounts or RRSPs. The third step is specifically for couples, and it's one most people miss entirely. It's called the retirement equalizer, also known as spousal RRSP. This isn't a separate account type you fill out after your TFSA. It's actually part of your RRSP strategy from step one. But it's powerful enough to warrant its own explanation. Here's the problem. If you and your spouse earn very different incomes, you pay more tax in retirement than you need to. Canada's tax system is progressive, meaning the more income you have, the higher your tax rate. So if one spouse has $80,000 in RRSP savings and the other has $20,000 in RRSP savings, the higher earning spouse will pay a much higher rate when they start withdrawing. The spousal RRSP lets higher earning spouse contribute to the lower earning spouse's RRSP. The higher earner still gets the deduction, but the lower earning spouse withdraws it in retirement at the lower rate. Meet David and Emma. David earns $110,000 and Emma earns $50,000. Over their careers, David contributes $200,000 to his RRSP and Emma contributes $50,000 to hers. In retirement, when they start withdrawing, David will pay tax at a much higher rate than Emma. But if David had contributed $75,000 to a spousal RRSP for Emma instead, their retirement incomes would be more balanced. Say $125,000 in David's RRSP and $125,000 in Emma's. That balance could save them $30,000 to $50,000 in taxes over their retirement. If there's an income gap in your household, use a spousal RRSP to level the retirement playing field. This is especially powerful if one spouse plans to retire early or take time off work. It is important to note that there's a 3-year attribution rule. The contributing spouse can't withdraw the funds for 3 years, or the tax deduction will be clawed back. Plan accordingly. Once you've maximized your RRSP for tax bracket purposes, your TFSA, and consider the spousal RRSP if you're married, the fourth step is your taxable investment account. Why does this come forth? Because you've already used your tax sheltered space. Your RRSP gave you an upfront deduction. Your TFSA shelters growth completely. Now, if you still have money to invest beyond those limits, you move to taxable accounts, but you do it strategically. A lot of people think taxable accounts are bad because you pay tax on the gains. But here's the thing, if you invest tax efficiently, you can still build significant wealth without giving up too much to the CRA. Here are some tax efficient strategies. 1. Hold Canadian dividend paying stocks. Canadian dividends get a tax credit that significantly reduces the tax you pay compared to interest income. 2. Use index funds or ETFs. These generate fewer taxable events like capital gains compared to actively managed funds. 3. Defer selling. You only pay capital tax gains when you sell. If you can hold for the long term, you defer the tax bill for years or even decades. Here's an example. If you invest $10,000 in the Canadian dividend ETF inside a taxable account, the dividends are taxed at a much lower effective rate than interest from a GIC or high interest savings account. Over 20 years, that difference could save you thousands. If you have money left to invest after maxing your RRSP and TFSA, open a taxable account and prioritize Canadian dividend stocks or broad market index funds. Avoid high interest investments like bonds or GICs in taxable accounts. Those are better suited for your RRSP. The fifth and final step is what I call the refund loop. And this is where most people leave money on the table. Here's what happens. You contribute to your RRSP, get a tax refund, and then spend it on a vacation or let it sit in your checking account. But that refund is actually free money that you can reinvest to accelerate your wealth. Let's go back to Michelle from step 1. She contributed $2,000 to her RRSP and got a $630 refund. Instead of spending it, she invested the $630 in her TFSA. Now, that money grows tax-free and compounds year after year. Over 20 years at 6% annual returns, that one-time $630 investment grows to over $2,000. And because it's in a TFSA, she pays zero tax on that growth. But here's where it gets even better. Next year, Sarah contributes more to her RRSP, gets another refund, and loops it back into her TFSA. Let's say over her career, she contributes $5,000 annually to her RRSP and reinvests $1,500 refunds into her TFSA each year. Over a 25-year career, this strategy can add an extra $80,000 to $100,000 to her retirement savings. When you get your tax refund, don't spend it. Immediately reinvest it. Either back into your RRSP if you have room and want to amplify next year's refund, or into your TFSA for tax-free growth. This is the step that separates intentional wealth builders from people who just hope it works out. All right, let's recap the exact order. Step 1, contribute to your RRSP to drop into a lower tax bracket. That is the marginal rate arbitrage. Step 2, max your TFSA with high growth investments. This is the growth shield. Step 3, use a spousal RRSP to balance retirement income. This is the retirement equalizer. Step 4, invest in a taxable account using tax efficient strategies, Canadian dividends and index funds. Step 5, reinvest your tax refund to create the refund loop and accelerate your wealth. This is the sequence. This is the order that saves you tens of thousands in taxes over your lifetime. If this was helpful, I'd love for you to subscribe. I post new videos every week on Canadian personal finance, retirement planning, and tax strategies that actually work. And if you have questions about your specific situation, drop them in the comments. I read every single one. Thank you for watching, and I'll see you in the next video.